guys, my name is Race Kendrick, and I'm just a college student who read a few investment books, and then that led to some further questions. So I figured I'd go ahead and make a video after I did a little bit more research and saw what made sense out of what I was reading. So what struck me more than anything, in Tony Robbins' first investment book, Seven Goals or Seven Strategies to Financial Freedom, or whatever it was, he talked a lot about index funds, but one of the biggest standouts, one of the things that he was questioned the most about after writing the book, was that he was able to get Ray Dalio's all-weather portfolio in there. And it really, what he said in there, or at least what the mix of the portfolio was, it almost seemed contradictory to what a lot of the rest of the book said to me. Because the whole book, he was talking about how important index funds are, and how much of an innovator Jack Bogle was in creating the index fund at Vanguard. Because basically, like, over time, the market averages around 10% increase. Like, give or take, it's going to go up, down, but over the course of history, it almost seemed like it's guaranteed to go up 10% on average. So it's like, okay, cool, index funds are the way to go. And then we get to the portfolio that's supposed to be the greatest portfolio there ever was, and it's only 30% stocks. And of course, those 30% stocks are going to be, in an index fund, it's going to be an index of the whole market, but it just didn't make a whole lot of sense to me. And so I watched the videos on it and read the section, and basically what he said was, or at least what Ray Dalio had said, is that there's four financial seasons. So there's high growth, high inflation, high growth, low inflation, low growth, low inflation, and low growth, high inflation. And the idea is that he was able to come up with a mix of assets that are going to be able to perform well in all four economic seasons. So I sort of was able to grasp that. Still, I figured, we're going to be growing with higher inflation the majority of the time, so why wouldn't you just be in that for most of the time anyways? Especially, I was only looking at through my lens as a young investor, thinking I just want to make the highest possible return over time. But then he talked about how he back tested it, and that whenever you back test that all-weather fund, it comes to it's either like an 8.5% or a 9% return, which seemed unreal for something that just had 30% stocks. Now, what's really, really crazy about it too is that the worst year that it had throughout he back tested it back to 81, and the worst year was right around 3%. Which we'll get into the numbers that I came up with here in a bit, and they aren't going to be exactly the same as that perfect portfolio that he constructed, even though he says it's not perfect. But we'll at least be able to kind of see how we can at least put it into our own portfolios, or practically through like our little Robinhood apps and that kind of thing. Yeah. So where was I going with that? Oh yeah. So basically, what I was thinking is, if going back to 81, the worst year you had was like it being down 3%, and but you average a return yearly of around 8.5% to 9%, maybe even 9.5%, maybe probably not quite 9.5%, but in thereabouts. I was wondering, well, if that's what you average, and this is just because I didn't have like a whole lot of investment experience prior to this, but I was thinking, if that's what you average, is just slightly below what the market brings back over time, because the market is like it's right between 9.5% and 10%. If it's just a little bit below what the market brings back, but that lowest year, or the worst return you had was around 3%, would the compounding effect of not losing your money and then having to gain it back, would that make it where actually over time you made more money than just having it in a fund that's pretty much all stocks, or like a more traditional, like an 80-20 type of mix? Because I figured, say you have like a 2008, and like in the 2008, a stock that was 80-20 dropped 28.21%, and that's with an index in bonds too. So I was thinking, well, and in order to gain back from a 28.21%, you basically have to double that loss in order to, or some. You guys know what I mean. You don't just gain another 28.21% and get up to where you were. You have to have a higher return to actually reach where you were prior. So I was thinking, well, if we miss that and we just keep going up, will that compounding of not losing actually result in a higher overall return? So that's what I wanted to research. I started out back testing back to 81. I tried to start doing the research back to 81 myself and building it up. I ended up finding a website, actually. I think it was called portfoliovisualizer.com or something. If you type that in, you'll find it real quick. It's really, really cool website. So I was able to actually kind of test that, and it only took me back to 2008 because a lot of these funds that I looked up, like the current funds that we could pull up to basically simulate that portfolio, they've only existed, like the newest one only existed back in 2008, so it only allowed us to go back that far. But still, it was able to kind of give me the answer I was looking for, since we did go through that major recession, and see how the response would be. And unfortunately, the all-weather fund, it doesn't actually, it's not going to make you more money over time. If you have it in all index funds, just like conventional wisdom would say, you're going to have a higher return over time. But that doesn't mean there aren't a lot of really cool redeeming qualities about the all-weather fund. So we'll just walk through what it is real quick, and what some of these numbers are, and what some of the reasons are that you might still want to be in an all-weather. So basically, you're going to be 30% stocks, so that'd be like an index fund. The one probably you're most likely to use would be the Vanguard Total Index. Then your long-term treasuries, which are 20-year treasuries, 40%. In this stuff, it doesn't sound like you should get any return on it whatsoever, but you do. Intermediate funds, or intermediary, I can't remember, but it's 7 to 10-year treasuries, 15% there, 7.5% in gold, 7.5% in commodities. In gold, we went ahead and used an ETF for reasons we'll get into later. You'll probably want to hold it physically if you can, and that's more like kind of a doomsday mentality. But if you're going to have gold, that's about the only reason you would get gold for, and then also the hedge against inflation, which is the idea here too. So the results here, the 80-20 did the best long term. So your finish was basically starting out. Say you had $10,000 to invest, and you rebalanced it once a year, which always do that. Mainly because once a year, that's how you're able to get the best tax advantage by not doing it more than once a year. And this website too, it gives you the ability to not rebalance and just let it go. And every single one of these things performed a lot worse. So make sure to rebalance every year, which basically means that there's a couple theories on rebalancing real quick. So some people say just at the start of the year, bring your portfolio back to whatever the mix is that you've got it at. Or some advisors, they'll say, wait until something happens in the market, like a big change, as long as it's been over a year, and then respond to that. And then that way you're able to kind of take the most advantage of that change. So say something happens where your stocks explode, rebalance then so you can make your money off your stocks, basically, and you put more money back in bonds, and that way you don't lose that possible big return. Anyways, but basically, so doing that and not adding any more money to it, it finished 10 years later, or finished in the present at $23,488, so a return of $13,488. The best year was 26.34. Worst year, you lost 28.21%. 60-40 mix finished at $21,585. Best year was a 19.23% return. Worst year was you lost 19.44%. Both of these were 2008. The all-weather, so it finished less than both of these, so $20,538. Best year was 16.74%, which is still pretty darn good for a fund that only has 30% in stocks. And in the worst year, this is what's really crazy. So you only lost 3.25%. Now, comparison's sake, what's kind of cool, what you would think would be a really conservative portfolio as well, you did 30% stocks, 70% bonds. Now, bear in mind, these bonds are not like the treasury bonds. These are like index bonds, which a lot of people would think is pretty safe since it's really widely diversified. The thing is, if this is what we did, you end up making less money, $18,310. The best year was less than the all-weather, 11.21%. The worst year, you lost 6.29%. So one could say that this might be a little bit more aggressive, just because your bonds are in actual companies, but at the same time, so you would expect a higher return for that reason. You also might hear an argument that says since it's diversified, it should be safer too, even though companies are more likely to default than the government, or at least we'd like to think so. But it still underperformed the all-weather pretty significantly. So now we'll go ahead and get into the reasons why you would want to be in the all-weather, even as a young investor, long-term. So if you're a young investor, you're probably of the mentality that you want to make your money work for you. You've probably read like Rich Dad Poor Dad and are thinking about how to create a passive income. Now, and there's obviously ways other than stocks and bonds to create a passive income and that are going to bring you more money than just having your money sit in a portfolio. So with an all-weather, you have a steady income, basically. Because if you look at, and it has a graph on that website that'll just show you what it's doing, it almost looks just like a flat line going up. And I'm sure it's about the same probably going back to 81. So you have a steady income basically every year. It seems like 8.5%, 9% higher each time. Okay, so with a traditional like an 80-20, say there was a really, really good investment opportunity come up. With, like, say it's real estate. For me, I'm around a lot of people who know a lot about trucks and things of that nature. So if they see something that's a really good deal, and I have the opportunity to be liquid and to purchase that and make some money off of it, I'd rather be in an all-weather, because say this is in a bad year or something crazy like this and everything's down, then if everything is down, then I have a lot less ability to go ahead and take advantage of that opportunity. So here, since I'm basically just going up every year, if an opportunity comes up, especially with today's apps, when not having to go through like traditional brokerage firms, we can just go straight to our phone, sell whatever we need to sell, and then buy whatever opportunity we have that comes up. Two, if you're going long term and you aren't, and you want to show this to somebody who's new to investing completely, they don't want to look at it, but they also, if they see that their portfolio has gone down 28.21%, they're going to say, "Get me out! I'm done. Never doing it again." They aren't going to have to worry about that, because it's easy on your heart, I guess. So basically, you won't get scared out of the market. Three, this is what, and I'd be curious if there's anybody on here who is like a retirement advisor, an investment advisor, because I'm not, and I haven't studied it extensively. It's not what I do or anything. But it seems like it'd be a really great idea for retirement, because your return and your income over time is really outstanding, but your risk is unbelievably low. So I feel like it almost eliminates the need for really complex retirement things with like annuities and all of that kind of stuff. So anybody who knows about that and would like to refute why this isn't a good idea for retirement, I'd be really interested to hear. But it seems like something that whenever you want to be safe, you could turn to this too. So that's the basis of kind of what all it is. That's what I'm planning on keeping in mind in that for most of the time, and then hopefully looking for other investment opportunities. Now, a few other ideas I just want to throw out there just to hear what other ideas people have in response to them. So right now we are approaching, been a little over 10 years, or we're approaching 10 years, I guess, since the last recession. And going back in U.S. history, the longest we've ever gone without having a recession is 10 years. So let's just say that in the next couple of years we can expect some kind of an economic slowdown. With that being the case, it'd be a lot better to be in something like this, because it's probably gonna keep us above water, if not even. And I honestly, in this worst year, it wasn't even in 2008; it was in 2015. This actually made money in 2008. So it'd be good to be in something like this, because you might even be able to make a little money when everything's falling apart. Now, this is where my question comes in. You rebalance after a recession. So basically, whether you're in stocks or in the all-weather, you're probably going to be buying a lot of equities. Say the recession hits and it becomes 6 months and they say, yep, we're in a recession. Why would somebody not switch maybe from an all-weather to then something more aggressive, buy up a lot of equities while it's really cheap, and then whenever everybody starts saying how great the economy is doing again, then switch back to something a little bit more conservative that's still going to make you a decent income. Which might be, that might be something I play with too. I'd like to hear what kind of rebuttals you guys have on stuff like that. And then it's worth mentioning, because whenever I've talked to other people about some of the questions I was going to bring up and why I think this is a really good idea, some of my friends, what the concerns that they have is with the total economic collapse. Which, it sounds crazy right off the bat, but it is worth entertaining the idea, because we are spending a lot of money, government-wise, and there's a lot of money in circulation right now. Like the Federal Reserve, back in 2008, whenever we did all the quantitative easing and bought all those bonds and put a bunch of currency into the economy, banks have a lot of money right now. So there's definitely a possibility for like a really rapid rise in inflation. And if there's a really rapid rise in inflation, obviously our bonds become pretty near worthless, So that could really tear some stuff up. Or like they don't worth a whole heck of a lot. And especially if we start to lose value in our currency because of something like that, and then because of our debt, other countries start to see us as a bad credit risk, or as a credit risk, then U.S. Treasury bonds, or like treasuries, which are supposed to be pretty near risk-free, they fall off, and then the dollar isn't really worth anything hardly anymore. And then we're pretty much in an economic collapse. So people would say, well, why would you want to be in treasuries then? Because if there is a collapse, and especially like the people that do see the doomsday stuff coming on early, that's going to be the first thing to go. And I'm thinking, well, I still wouldn't mind being in this, because if there is a collapse, no matter what you're in, unless you're all gold, you're in trouble, And if you're all in gold, then you better be able to arm yourself and defend yourself, because if everything is chaos and you have a bunch of gold, then you might be a target. I don't know. But either way, if everything goes downhill, then everybody's going to be screwed. So, assuming things don't go downhill, which is I feel like the only way to live and try to live in a way that you're trying to grow, then you have to almost assume that things are going to go up. Maybe, if you are concerned about a collapse, then have yourself like a generator and some food, and like watch the Doomsday Prepper show and all of that stuff. But I just figured I'd go ahead and address that as well, because I don't know, I guess it ties in a little bit. But either way, I hope this helps you guys a little bit. Those questions that I posed to you, I'd really like to hear back from you. So I'll see you guys if I ever do another one of these.